Welcome back to the Miami Real Estate Podcast powered by Cervera Real Estate. Today, we have your economic insights from the month of August with Dr. Marci Rossell, Chief Economist, leading real estate companies of the world.
We have our amazing Dr. Marci Rossell here for us to carry us through a half hour of juicy economic goodness. Let's start with sort of what happened in the last couple of weeks here with markets. You and I have been keeping an eye on the Japanese economy for a while. There's been some faltering there. Earlier this month, the Bank of Japan really kind of played a prominent role as one of the key players in kicking off something of a little bit of a global economic tailspin. So let's start with having you kind of walk us through what happened there.
Okay, well, as you sort of just a review for everybody, central banks pretty much around the world have raised rates over the last 2 years in an effort to get inflation under control. Everybody's been kind of holding steady around the globe with high interest rates pretty much everywhere. Central banks in Switzerland have already lowered rates just a little bit. The US Central Bank, the Federal Reserve, is expected to lower rates at their September meeting. So across the globe, interest rates are expected to be moving down, with pretty much one major exception, and that is Japan. So Japan is sort of, its economy has kind of, it's always kind of doing its own thing. It doesn't sort of move with the rest of the globe in exactly the same way because they have a different set of challenges. They have demographic decline. They've had decades of deflation. So they have had really low interest rates for a really long time, and they've kept them there for a really long time. So their monetary policy has been moving kind of out of step with the rest of the world. So there have been they've seen some signs of inflation. Their economy has picked up speed just a little bit. And so what they did earlier last month, as you said, was they began to raise rates, right? And so they surprised markets. And this is the key. Markets were surprised by this rate increase. So one of the things that central banks around the globe do is they always try to telegraph the direction that policy is going. They may not know for sure, but no one is expecting the Federal Reserve in the US to increase rates, right? Because they've been talking and talking, the next move is going to be down. Yep. If you surprise markets with a move like Japan did, it can have reverberations across the globe, and indeed it did. And the main reason is something pretty obscure, but I think it's worth walking everybody through really quickly. It's something called the carry trade. So when I was an economist back on Wall Street, it's very common for investors, big investors, hedge funds, mutual funds, to borrow money at a low interest rate and then go around the globe in search of higher returns. So for instance, I borrow money in Japan at a really low interest rate, and then I invested in Mexico, Brazil, Turkey, Pakistan, or maybe even in US technology stocks at a higher interest rate. That's called the carry trade. And so it's a really easy way to make money, right? You just borrow cheap money and use it for something that pays a higher rate of return. And it works great unless the central bank in Japan unexpectedly raises rates. And so suddenly that carry trade, the borrowing in one currency to buy assets in another currency, becomes much less profitable, maybe even unprofitable. And everyone runs for the doors at exactly the same time. And that is what happened in July and early August. And so we saw stock markets around the globe take these big dives. Everybody starts talking about recession in the US. Not happening. That is not at all.
And we're going to talk a little bit more about that in a minute, but that is a great summary of what is to come later this conversation.
Right. So it all comes down to this obscure financial thing called the carry trade, which is why in about the last week, you've seen everybody pile back into particularly US stocks, and you've seen this big rally because now that sort of technical unwinding of the carry trade is over, everybody runs for the doors at the same time, and then miraculously, everybody goes back into the market all at exactly the same time.
Cool. Okay. So just sticking with Japan for another minute. What's next there though? I mean, where are we now? And
yeah, what's next? I bet they don't do anything for a while. I bet
they're hiding.
Sorry about that. Our bad. No more. So basically, they've raised rates twice, and given how slowly their economy tends to grow, given how we're not talking about high rates of inflation, we're talking about a little bit of inflation.
Right.
They will probably hold steady and wait and see what the rest of the world does over the next 6 months or so to policy. So my guess is they will be holding firm after this experience.
Okay. All right. So let's turn to the US, where hopefully we won't be doing any oopses ourselves here. We have been we've been talking for a while, feeling kind of bullish about a September cut by the Feds. That prediction has really kind of been reinforced recently. July numbers are showing annual inflation at around 2.9%, which is the lowest we've seen since 2021, right? And so September's looking pretty good. Confirm that or deny it, but then talk about what's going on the rest of the year. You and I have talked a little bit about it's sort of psychologically tricky for the Feds right now because we have a significant political event happening in November, and so that can cause some odd hesitancy, I believe, with the Feds. Talk us through all of that.
That's right. Well, we've said before, I can tell you from my own experience of being an economist at the Federal Reserve Bank of Dallas early in my career, the Federal Reserve takes great pains to appear to be politically unbiased, right? They don't want to get involved in elections. They don't want to be seen as tipping the scale in one direction or the other. Their personal politics, trust me on this. People who are central bankers really don't want to deal with politics. That's not why they do what they do. They can go be investment bankers, guys. They can go do other stuff. These are all really smart people. They do it because I really believe they care about public policy. They care about the economy and monetary policy, and they try to keep their distance from the election cycle. They really do. But the economy is not really cooperating with them right now, in the sense that inflation in the US has come down to what anyone would consider to be a normal level. 2.9%, you're there. It's not the Federal Reserve's 2%, but given that it takes time for those inflation numbers to come down, and there's a lot of tightening built into the system right now, because they are also still quantitatively tightening in the background. So even though rates aren't still going up, remember that they are shrinking their balance sheet every month. So there's still tightening happening. So inflation's headed to 2%. Nobody doubts that any longer, but they don't want it to go to zero, and they don't want it to affect labor markets. Now, there are tiny signs, and when I say tiny, my friends, I'm talking itty bitty bobini. We are not talking about big changes in labor markets, but the unemployment rate has drifted above 4%, right? And there's no evidence of mass layoffs, because remember, we all look at initial claims for unemployment benefits every single week. So that would tell us, if there was an increase in that number, that would tell us that people are being laid off. Guys, it's just not there. So this talk of weaker labor markets, when I say there's just a teeny bit of evidence of that, I'm talking the tiniest little bit. So you haven't seen a significant weakening, but they certainly don't want to get it any worse, because that has real human ramifications. So they're poised for a September rate cut. I think they will do it, and then I think they will wait until after the election for their second rate cut. But probably you're only going to see the Fed funds rate drop to about 4.5% when this is all said and done. So if you've got clients who are saying, hey, I'm going to wait till mortgage rates are back at 3.5, 4, tell them, Marci said that's not what's going to happen, that you're going to get another 100 basis points on the short end, which means best case scenario, you're going to get mortgage rates at 5.5 next year. That's sort of what I would expect if everything continues to go as it has been going, and there are no other sort of surprises like, we saw with Japan.
Yep. Yeah. Econ 101 moment here, Marci. Whenever you mention quantitative tightening, a couple folks in the audience like, can you remind us? Can you talk through what that means? Because I think it's an important point right now. Yeah.
Sure. That's right. So whenever there's a financial crisis, one of the things that the Federal Reserve does to stabilize financial markets is it starts to buy up treasuries, right? And so it buys treasuries from banks, it buys them on the open market, but it buys up treasuries and mortgage-backed securities to some extent in an effort to provide a foundation for financial markets in times of crisis. So the last two times that they've done that aggressively, 2008, 2009, they did it. So when they do that, their balance sheet, their holdings of treasuries typically takes a big step up. So it happened after 2008, 2009. It happened again during COVID, where they stepped in, bought lots of treasuries, bought lots of mortgage-backed securities in an effort to stabilize markets. So the Federal Reserve is sitting there, just like you or I. Imagine you had a big portfolio full of bonds, right? And the bonds are generating income and they're doing their thing. But the Federal Reserve promises to bring their holdings down over time. And so what they do is they begin to let those treasuries roll off of their balance sheets. They're not involved in actively selling them, but they just basically stop holding them, which means if they're not holding them, someone else has to as the US rolls over its debt. So basically, all that it means is that they're holding fewer treasuries, and so it tightens monetary conditions very slowly. So they try to do it in a way that's not particularly disruptive, but we have seen at times something called taper tantrums. I don't know if that's a cliche you're familiar with. You may have to be a monetary policy geek to really get it. But every once in a while, if they sell them off too fast, markets go, whoop, 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 that's too quick. Like, it's like pinching. You can take a little pinch, but if they pinch too hard, markets scream back and they'll slow it down. So in the background, they are selling off treasuries. They've been pinching and pinching and pinching. And up until this point, nothing is sort of saying stop, stop, stop. So they're going to keep going until somewhere financial markets go, yeah, you just pinched us a little too hard. But we're not there yet. But it is happening, which means credit conditions just slowly get tighter. It's like a little corset, tighter, tighter, tighter.
All right, I want to dig into two. Thank you for that. I want to dig into two of the points that you made just a few minutes ago, and just go sort of deeper level on both of them. First of all, I want to talk a little bit about the mortgage rates, and then second, I want to talk a little bit more about sort of the big picture, overall, your thoughts on a slowing economy. So let's start with the mortgage rates. We are now, more than halfway through the year. With everything that's going on right now, what really do you expect for in terms of some comfort for consumers in the mortgage rates? We're bumpy, right? I mean, a report out of Freddie Mac yesterday says that we saw an uptick in mortgage rates for the first time in 3 weeks. We're looking for some consistency, Marci. Is that going to happen before the end of the year?
Well, here's where we are right now in terms of mortgage rates, I believe. I don't know if anybody remembers, but we talked, a few months back about one of the issues when mortgage rates spike the way that they have is this problem of refinancing risk. So any mortgage that's been written over the last 18 months at those high interest rates, right? And some of you may have done that. People who are, taking out mortgages, and they're taking them out, but what are they saying? And what are you probably saying to them, which is really smart? Don't worry, when rates come down, you can just refi, right? And that's what everybody knows everyone's going to do. The investors who buy those packages of mortgage-backed securities know that they're not going to be 30-year securities. They know they have this refinancing risk built into them. So they buy something that is supposed to give them a stream of income for 30 years, but they know it's not going to. So they will demand a little bit more interest, refi risk, to compensate them for this. So that's why interest rates, they kind of go up like this, and then they went and took this real upward spike. That's that layering on of refi risk. Now, there's no refi risk in a mortgage at 3.5%. No one's ever going to refi that. Probably there's no refi risk with mortgages at 4.5, maybe even 5. So what's sort of caused interest rates to spike in the short term going up also means that the ride down goes a little bit faster too, as the refi risk starts to roll off of these new loans. Now, I don't think we're there yet. I think anytime mortgage rates are really above like 5.5, you're going to have this refi risk built into it. But as soon as you start to sort of 5.5 comes into view, the refi risk starts to roll off of these securities. And so that's why we're in this sort of bumpy period. And when it does start to go down, it's going to the roller coaster is going to fall really quick, just like it went up really quick.
Okay, fantastic. I want to now go into sort of the bigger picture. I want to start with U.S. economy, but also we've got a fantastic question from Barry. Hi, Barry, on the global economic conditions as well. So let's start with the U.S. and then I'm going to go to Barry's question here too. So overall, what is the sort of that narrative out there of a slowing U.S. economy? I mean, jobs market is going strong. Commerce Department just reported that we're all shopping our little retail hearts out right now. What are your thoughts? Start with US, and then again, I'm going to go to the global picture here.
That's right. I do not like to be critical of my peers in the media because I was a media economist at one point, and I understand the very hard job that they do. And I really do believe that most of them want to present unbiased truthfulness. That's what they're after. But it's easy to grab onto the latest cliche. And once you start seeing other people sort of write, oh, slowing economy, it just becomes easy to drop it into the story without going back and going, hey, is there any evidence of this slowdown that you're talking about? Now, I know prices are still high. I know that prices are 25% higher today than they were before the pandemic. That's really real. That's in the data. That's true in the US. And I am talking US, Barry. I'll get to global in just a minute, right? But when you look at evidence of the economy actually slowing down, I got to see some job loss. I'm not seeing it. I have to see some slowdown in spending. Like you just said, I'm not seeing it. Now, I am seeing a slowdown in home building, right? We got sort of home building back to the level where it was in April of 2020. But I'm going to say two things about those numbers. They're highly variable. They're highly prone to revision, and no one's going to build right now when they know the Federal Reserve is going to cut rates in September. So everything's just hold until then. So I don't put a lot of stock in those numbers as a signal of economic deterioration. So the data's not there. I look at something called real GDP, GDP now from the Atlanta Fed. That's a data that comes out every single day. They update it. It's a real-time indicator of GDP, 2.9%. It had to be negative for it to be a recession. So we are not in recession territory by any stretch of the imagination. The rest of the world, though, is experiencing some pain, which gets me to a little bit of the global economic outlook. When Japan's Federal Reserve or central bank raised rates, this sent economic shocks around the globe, particularly in countries where perhaps their currency had been a little bit overvalued and people were a little bit concerned in some emerging markets that maybe their currencies had become overvalued relative to the US dollar. So suddenly you saw this giant flight to quality into US assets, right? So treasury bonds, the dollar, at the expense of currencies around the world, particularly emerging market currencies. So the reality, the unfortunate reality for countries around the world is that, I have someone said, when the US sort of sneezes, the rest of the world catches the flu, right? And so there was kind of a sneeze there was a cough in Japan that gave us a sneeze in the US, and the rest of the world quickly caught the flu from a financial market point of view. So as the Federal Reserve begins to lower rates, right, I think this is going to be extremely helpful for emerging markets around the globe, right? So lower US rates mean that there are countries that tend to attract capital when that happens. So US lowers rates, dollar gets cheaper, and that means it tends to benefit places like Mexico, Brazil, Turkey, South Africa, all of those countries that when the US lowers rates, funds tend to shift in those directions. So as soon as the Federal Reserve moves in September, I will be watching currency markets very, very closely to see how they react, if they sort of react as they typically do. So I'm going to expect the same reaction you normally get, that there'll be a flow of funds into emerging markets when the Federal Reserve starts to cut rates.
Fantastic. Okay, thank you. And Barry, if there's any follow-up you want there, or anybody else on our globe, we've got quite a few global folks here. Put those in, and I'll hit Marci before the end of the program as well. I do want to talk about housing prices in a little bit more detail as well. You've already referenced it a little bit, but we're as you said, no big spike in new constructions expected. I'm assuming we're not in for any surprises on the U.S. housing pricing front, and if you've got some stats on globally as well, let's talk about that. But let's kind of wrap up with your thoughts on what we're going to be seeing, all other factors that we've discussed today taken into account when it comes to housing prices through the end of the year.
You know, I don't see any of the factors that would normally move housing prices really being in play. So the last time you saw a big decline in housing prices was 2008, 2009, right? So you had global financial crisis that turns into a housing market crisis. Now, I'm going to be real honest with you, my friends. About 2-3 weeks ago, I was watching very carefully financial markets began to unravel. And I thought, ooh, all right, is this another 2008, 2009 moment? Is there going to be something big that breaks? It does not appear that that's happened. Things have settled back down. But when I saw, the Japanese stock market decline like it did in 1987, right? I got a little concerned. Not gonna lie, I'm gonna tell you, I don't always think everything's hunky-dory. Had we done this call that morning, I would have said, "Oh, Jess, I'm worried. I'm watching this really, really closely."
Yeah.
Things have settled back down. So I don't see any kind of, crisis that would put downward pressure on global housing prices. What I do see is a world who simply over the last 5 years has not kept up with housing demand. Building slowed down during the pandemic. It slowed down pretty much everywhere. And so we have this we're still playing catch up to that. And so globally, supply and demand conditions are still sort of short on supply and strong on demand. And that's basically where you're going to get house prices coming down over the next year.
All right, fantastic. Let's see, we've got another question. We can do a little bit of audience Q&A here. Credit card debt has reached a record high. How is that going to affect the economy?
Sure. Credit card debt declines when economies go into recession. So I want to be very, very clear. It's amazing. If I put up a chart of credit card decline, what you would see is it is one of the most powerful pro-cyclical indicators out there. It goes up when everybody's got a job and they feel good, and it goes down when everything goes up. So basically what happened was during COVID-19, credit card debt collapsed. Everybody was worried about losing their job. They weren't spending money because they couldn't travel, they couldn't eat out, they were afraid to go get a massage. So savings rates spiked and credit card debt declined. This is the incredible thing about macroeconomics. What might be bad for an individual, right? High credit card debt levels, right? I mean, that might not be good for you, but as an indicator of how people feel about the economy, when I see credit card levels, payments, credit card debt rise, collectively, that means everybody goes, I got a job, I'll buy the handbag, I'll put it on my credit card, and I'll be able to pay the bill later because I'll know I'll have a job. And in fact, I think my paycheck and my bonus are going to be big this year. So I'm going to go ahead and buy the handbag right now because in November, I'm going to get my bonus. That is the mentality, which at an individual level might not be such a good idea, but at a macroeconomic level actually means that people are confident in the future. So when I see high levels of credit card debt, first of all, it means people are confident about the future. And secondly, those numbers are not deflated for inflation, right? So remember how I said prices are 25% higher today than they were 4 years ago, right? So that's a reality. There was a big burst of inflation because of supply chain disruptions and income support during the pandemic that supported demand. So prices for everything went up like this. But see, they're not continuing to go up. But what that means is that the value of credit card debt reflects that 25% increase in prices as well. So that's something you need to keep in mind when you just look at those raw numbers.
Don't you feel that people are charging their credit cards because they don't have enough money? I've spoken to so many people in businesses that are having to cut their staff and not making what they have in the past. What are your thoughts?
There is anecdotal evidence of that. That's absolutely true. And remember what I said, what motivates an individual to run up their credit card bills can be very different than what happens when you add all of those people up. So it's the disconnect between individual data and macroeconomic data. So that is a very real thing. Yes, some people use their credit cards when they can't afford to in the short run. But if those people really thought their long-term economic prospects were bad, they wouldn't be spending money on anything. So that's really the reality. So people can use it to sort of bridge themselves short term, but they won't use it to bridge in the long term because quite frankly, they can't. So do be careful with that anecdotal evidence. It can look very different than when you look at macroeconomic evidence. So those stories are very real. I do not doubt that one bit. And part of it is people are running out of the savings that they accumulated during COVID. And people don't remember what the world was like 10 years ago or 12 years ago. They remember only what it was like yesterday.